My entire portfolio is in red right now. I am 22 right now. I started investing during the COVID time. Like, what should I do? I mean,
you haven't seen it because you started at 2021, you saw maybe a 10% fall and then back up and then 50. Now you're seeing 20%. Shit, I bought these stocks, they went up for 2 years, now they're going down despite all my hard work.
Is there any particular sector which performs really well when the markets go down?
Every business that doesn't die, is it a great investment? When the US stops fighting its own tail, then we will see that stability and then the markets will emerge out of that, right? Because when people are the most scared, is the right time to invest.
So today I have Deepak Shenoy, founder of Capital Mind with me. Before I tell you what the show is all about, let me ask you this question. Should I sell everything right now?
Yeah, if you need the money, sure. But if you don't need the money, then why are you doing it?
I mean, money, everyone needs
if you need the money to keep in your bank account and you're afraid, I think, yes, of course, you should do it. But that's like, when you're going to climb a mountain, you're somewhere in the middle, you'll feel tired and you'll say, I can still go back down, so might as well go back down. So my funda is the people who survive reach the top. So people who will sell will get out. If you don't have a life-limiting injury that does not allow you to go to the top, and you're fine and healthy, then you might as well go to the top. Then and experience the thing. Because otherwise you'll sit in the down and just regret not having seen anything or gone up at all. So I think that selling because of this fear and all that stuff is anybody who has been in the markets for long will tell you that these things will happen. So selling everything is a natural feeling. It's not like people should not get it. But I'm just saying that there's one ad, right? Dar ke aage jeet hai. So that's the thing, that you will always have fear. It's not that you don't have fear at all, but you have to conquer it at some level. If it's only fear that's driving you, don't do it. If it is something else, like I need to pay for something, I have a fee to pay, I have a bill to pay, a house I have to make a down payment. Yeah, fine, sell them. You need the money. That's the reason to sell. But I think just selling because there's fear in the market is a little like not writing an exam because it's too tough. Maybe you can do that, but in the end, if you don't write the exam, how do you know how you'll perform? Like if you don't bet, you won't win. There was a saying by this guy. He said, if you don't bet, you won't win. Because if you're not even there in the game, then there are no chances of winning, right? So you can take yourself out of the game anytime you want. But remember, the game is there. It's going to be there forever, and you have to be in it in some way to win. So if you're getting out now because of fear, the only thing you should ask yourself is, how do I know when it is time to get back in?
Got it.
Because fear will take you out.
I mean, that's the hard part, right? When too.
Yeah, I mean, selling is easy. Buying back in is not easy. And we also have trouble. In so many years of experience, you still end up with this. Should I now get back in? Should I buy back? I've sold something at some value. Should I get back? These are natural challenges, but you answer them. Eventually, you'll answer them with some layer of maturity that can only come from having been beaten down or making the mistakes in the past. So my funda is, yes, you want to sell. Then you'll feel it. And then you'll come back that's the point, because I can't tell you, nobody tells you that it's painful, but hold on. You have to feel the pain. Only then do you grow up, right? So you want to sell, go ahead and sell. Then you'll feel regret and then you'll come back. But if you keep doing this, you ask 100 people, one person will say sell, another person will say buy, then you'll sell for one day, then you'll go and buy the other day, then you have to make your own decisions in the end.
Got it.
So I'm only giving you context. So in the end, that decision to sell or not sell, the pain is too much.
Onus is on me.
Is on you. If you over leverage yourself, you borrowed money to invest in the market, stupid idea, sell, regret it, make that mistake. And
have you ever done it? Borrowed money?
Yeah, I have. I mean, I have done it even in the recent past. So it's not like I don't do it. But I know what I can take and what I can't. So for me, it's like it doesn't matter to me as much in terms of even a 30% fall would not hurt me.
Got it.
So I would still stay invested. So then I'm okay. I'm in a different zone because I have leveraged myself to buy markets and lost a truckload of money also. So I've learned from that and said, okay, only take how much you can, lose.
Got it. So for your context, like as I was telling you, I am 22 right now. I started investing maybe like 3 or 4 years back during the COVID time. So we thought now it seems like there's a bear market or markets are correcting. And we thought we'll do a show, limited series of sorts. We'll call this baby's first bear market. And the baby here is obviously me. So I thought I'll talk to experts like you and try to learn from your experience, what even is a bear market, because I am still learning about the markets, intricacies of the markets. So yeah, I think this question was a good segue into the show. I want to know first on a broader level, what's happening in the markets currently?
So I think to a large extent, markets are like this. They just haven't been like this in the year that you've been in the markets, in the years. But in general, even when I started, it was 2000, maybe 3, 2004 type thing. Okay. That is 2004, if I remember right. I even took a break from work to learn day trading, to see how it works.
Okay.
In 2004, in January, the market fell quite considerably. And in May, when there was an election, and I think the left was going to be responsible for coming to power, there was a change of government. There was a lower circuit on the Nifty. You haven't seen a lower circuit on the Nifty?
I don't think so.
Yeah. So there was a lower circuit on the Nifty, it was down 10%. And then
what does lower circuit on the...
So on the Nifty, there's a 10% circuit. The market can't go below 10% initially. Then it goes down 10%, then they hold off.
Okay.
And then they wait for an hour. And then if it goes down another 5%, so 15%, it will then hold off for 2 more hours.
Oh.
And if it goes down even further, then it crashes at 20%, I think. I think there's 2 things over there. So what happened then was it did fall down 10%. In 2004, between I think May and July, it was down 30%. We are talking of 6 months and the market is down maybe 15 or 16% on the Nifty, maybe 20%, 25% on the mid caps and small caps. This is nothing because you're talking 6 months, and that time the 30% down was on the Nifty. The mid caps and small caps were butchered by that time. So
This is early 2000s.
This is 2004. This is 2004. In 2005 also there was a fall, about 15-20%. 2006 there was a 33% fall. In 2007 there was 120% fall and another lower circuit on the Nifty in the year that the market went up double. Nearly.
Okay.
It went up nearly 40% on that year or something, crazy number. But in that year there was a 20% fall and a lower circuit on the Nifty in different times. One was in February, one was in... So while I grew up in that environment, I saw, by the way, 2004 to 2007 are the best years of the Indian market by far. We have not seen a market like that.
Best why?
It was crazy. The Nifty itself went up more than 3x.
Okay.
Or 3x, a little bit more, 3x in 4 years. That's equivalent to when you probably started Nifty was what? You must have started after COVID.
Yeah, I started around COVID, 2021. Yeah.
2021. So the market would have been maybe 10,000, 11,000, 12,000. Imagine the market goes from 11,000 to 35,000 or 34,000 in 3 years. We are at 22. So right, we've doubled in 5 years. But that time it tripled in 4 years.
And then it came.
Then it crashed down 80%. So it's not easy to have seen that fall also. But that was in 2008. So you sort of saw this massive up run, but each of these up runs years saw 30%, 20% fall. You haven't seen it because you started at 2021. You saw maybe a 10% fall and then back up and then 50. Now you're seeing 20%. And you're seeing 20% as saying it's a little high. So to me, it's like, okay, we're back to the old norm of having rough markets.
So 20% corrections are normal then?
30% corrections are normal. We haven't seen 30%.
So would you call this a bear market or not?
So technical definition is 20% down is a bear market. Right. 20% down has not happened on the Nifty. Yeah. The Nifty is not in a bear market, but the small and mid caps are.
But it seems like we're heading into that direction?
So this seems like is a tough question to ask because this seems like it always seems like. Seems like going up forever, seems like going down forever, or always seems like. But if it does, the technical definitions you have to reach. So until you reach that 20% down, and some people mark it with moving averages, saying if the Nifty is below its, say, 200-day moving average or a 300-day moving average, then it's in a bear market, which is true right now, I think. And then to that extent, yes. But I would say the technical definition being 20% off the top has not yet happened. And we may go there. It's not like we won't. But I think having those kind of corrections is perfectly normal. And at 14% down, which is what it is right now, and today is what, March 7th. And I don't think this is a meaningful correction from that perspective. So people are feeling miserable, but I'm like, okay, either there's a lot more stuff to come and we should be ready for that. Or the market will go from here and we will not learn the lessons we should learn anyways. We're learning those lessons, but I don't think the lessons have been learned. So if the market goes back up, it will be like this lesson hasn't been learned, because what will happen is the next series of people will come and say, when the market falls 6 months, no, you just buy. That's not the answer. We've seen deep bear periods in the past, and I've seen people lose their shirts in 2008. But even then, the market did come back very meaningfully in the next 6 to 8 months, though it was a 1 year of a fall. I think cycles have shortened. So, and domestic investors are very strong. So even today, we're seeing a lot more investment by Indian investors, domestic investors.
By domestic, you mean mutual funds, retail?
And retail, Indian residents investing either directly or indirectly to the markets. This is very strongly happening. Foreign investors are reducing their exposure, which is also fine. There's nothing wrong with that.
Why is that the case? Why are foreign investors?
They have multiple reasons for that. Maybe they don't like what's happening over here. We are overvalued compared to, say, Korea. Korea is valued at like 4 or 5 times earnings. So you might say, I want to shift some money from here to Korea. Korea is a reasonably sized comparison. China is there, but China is terribly difficult to invest in. So I don't think India makes a major difference to China. But in general, foreign investors have been selling to buy past their portfolios. But there's a lot of factors. If you think about why FIIs behave the way they are, sometimes it's just allocations. I don't want to allocate to emerging markets anymore because I wanted emerging markets as a kicker. I was not getting enough yield in American government bonds or European government bonds. Therefore, I come to India and say, listen, I think I'll get a better return from here. That 1 year will give me 40-50%. That'll be great. I'll take the money and this thing. So what typically happens at these times is that when American yields in the bond market start going up, when European bond yields start going up, you just say, well, I don't need the kind of risk that India is giving, so I might as well move my money out. To a certain extent, there's a currency risk as well. That currency risk kind of surfaces at times like this, and it gets exaggerated because once you see currency risk, then you sell, you cause more currency risk and so on. So that efforts, these kind of things are ongoing. But typically, FPIs come back pretty strongly in the long term.
That doesn't have anything to do with India growth story or anything.
It'll come. Even that will be there because at some level it'll be like, oh, I thought we'll grow so much, but you're not growing so much, which is fine. That's also something that's valuable. And it's not like India there aren't cheap companies in India, or there aren't ridiculously expensive companies. But it is true that India has a lot of reasons for improvement that it must be doing. It needs to do. For instance, it needs to ease labor laws and some of the laws that we call environment laws, but they actually are laws for people to extract rents out of businessmen. So these are laws which say, oh, I want to protect the environment, so you have to get so many permissions from 17 different environmental agencies. But each of those agencies then demands a bribe to get your factory to work. And then you need to keep getting them every 6 months, and somebody changes, they decide to put some random fine on you. So your life is, devoted to kind of be feeding these people rather than trying to deal with the business itself. At some point, you're kind of like, what the hell? I would rather not 17 people, but make it one person, make it a fee rather than a bribe. Then I'm happy. I'll pay this environment, whatever this fee is. But if you create arbitrariness, saying that guy will come and say your red paint is harming the environment, this kind of stuff, that arbitrariness causes corruption, causes damage. These are things we should fix.
Got it.
And foreign investors will also look at this and say, well, you guys are getting better because now at least you're not doing stupid things. So let me, this thing. So I'm not saying that reduce the laws to harm the environment. I'm saying that a lot of laws have been created in the guise of environment, but does not help the environment. But you cannot defend it. Like for instance, I can tell you wear a helmet when you go outside, even when you're walking on the street, right?
Yeah.
You cannot tell me why. I can say, no, I'm protecting you because you could fall and tomato can fall, I mean, a coconut can fall on your head, right? Tomato is still okay, but a coconut can fall on your head. And you can never deny that because yes, a coconut can fall on your head. I mean, somewhere, somebody, a coconut has fallen on somebody's head.
That's a good enough.
Yeah. So now I can make this law. You cannot defend me. I can say it is for your protection. And at some point there is this somebody has to come and say like this Doge thing in the US that's happening. Boss, calm down because this shit is insane. We are inconveniencing everybody, fining anybody who does not have a helmet, including kids who are just walking on the street. Yes, there is a problem, but there are these points where we're going to willing to be taking those risks and willing to not. We have to ease the regulations down. The same thing with this environmental stuff. It's like, of course, yeah, you can prove that my paint is harming the environment, but that does not mean I don't paint my walls. Or you can't come and say I'll fine you because you painted your walls. We have to take that reasonability argument, and somebody who's not a beneficiary of these environmental laws or so-called environmental laws should be making those calls. Somebody who comes in and says, boss, I'm here to actually say the business side needs to be very clearly determined that it is harming. And then therefore I'm going to consolidate these agencies into one. The same thing with the forest laws. You have very arbitrary forest laws. So like this, there are hundreds of rules. I'm talking about forest, environment, labor, permissions. You have an EPF.
These are bunch of reasons why FIIs.
No, these are not. I think these are a bunch of reasons why if you ease up, the foreign participation in our equities will increase regardless of anything else, because they'll be like, okay, now we're getting freedom to grow, and forget that India will only benefit, right? So you ease up the laws. So at that level, there's one. There's also second thing is, of course, they are cyclical. They come and they go. They've always been like that. I have seen FPIs come, but by and large they come. I mean, they've gone only 6 months. By the end of the year, they may be back. We're cribbing about some 6 months and 300,000 crores. It's not a much. That's only about 3% of their portfolio. Are you saying that they shouldn't even sell 3% of their portfolio? I think that's crazy.
Out of their overall, whichever countries they invest in, India is...
I'm saying out of what they hold in India, they have sold 3%.
Okay, got it.
So, I mean, 3% anybody can sell. And you're telling me that a whole FPI community as a whole cannot reduce India allocation by 3%, and we should crib about that? I think it's unfair. I think you should even think of them as going at 10%. They will reduce 10% of their holdings over a period of time and then bring back and go. So to that extent, I think more money will come later if it goes now. So let it go. It's just normal cyclical moves.
Like, as you said previously, you've seen bunch of bear markets. This doesn't seem like one, it's just normal correction or whatever it is. Why is the market even correcting? Is it because of overvaluation, or is it because of, why are the markets going up?
That's a good question. See, markets are not designed to go only one way. They go both. Some stocks will correct normally as a part of this thing. Some stocks will have fraud. Some stocks are cyclical. People put too much enthusiasm in them when the cycles change. It's natural. If you sell a lot of cars, then people don't buy tires for the next 2-3 years, because the relative sales of tires goes into the cars. And then when the car sales slow down, there are not so many cars being sold, therefore tire sales come off, right? So the tire sales go through a down cycle. But after 5 years, everybody has to change tires. So even if car sales don't go up, tire sales go up because people have to change their tires. So this is the natural cyclical part of the tire industry. There is a part that's a down cycle, there's a part that's an up cycle. We understand this. Right. This is how markets are. Markets have up cycles and down cycles. You have good times of the year and you have bad times of the year. And then those times exaggerate themselves with social media, because everybody amplifies and says, get out, do this, do that. All the bears come out of their hibernation. They go back into hibernation when it goes back. So it's a natural cycle of things. why is always a useful question, because there will be a different answer to why each time, but it's always the same relative answer. Stocks get overvalued and then they come back and get undervalued.
Right.
The stocks get too much attention, a lot of the wrong stocks get too much attention, and then the wrong stocks lose their mojo. Then the right stocks also lose their mojo, but the right stocks come back up. The wrong stocks die away. It's a natural cycle of. So we are not used to this because mostly as people who are young, your lives are mostly up in one direction, right? So you are mostly like, every year I give exam, I go to the next class.
Right.
There is no like, I failed, I go back 2 classes down. Like almost everybody goes up. You finish your 12th, you do something, you do your thing, maybe some engineer. Everybody struggle, but almost everybody sees only linear lines up. So especially among the most intelligent of people, the issue is that you never faced failure before. And even for most normal people, you wouldn't have seen major levels of failure. I mean, maybe one subject you would have had a bad mark, maybe even failed a subject, but by and large, you somehow find your way out and pass. These are the same people when they come into the stock market, because they haven't seen the failures, they end up with this issue of, shit, I bought these stocks, they went up for 2 years, now they're going down despite all my hard work.
So this is the question that I had. So like as I told you, 3-4 years back, I started investing. So I've made a bunch of investments, bought a bunch of stocks, mutual funds, and a bunch of things over the past 3-4 years. My entire portfolio is in red right now. Like, what should I do? I mean, like that's
Is it because, let me ask you this, is it because of it's red because you bought something 3 years back and it's down from then? Or is it because you bought something, sold something, bought something, sold something, and what you bought in the last year is down in the red?
mix of everything. I mean, I bought something, I sold it, and then there are some stuff that I've bought and held it till now, and it's in red.
Okay.
So
you've got, what you should look at really is your own track record in terms of an IRR of sorts.
okay, what's IRR?
IRR is an internal rate of return. It's basically how much your money has earned for you, or how much you made out of your own money. Okay. Most people don't know this because it is almost impossible, and very few sites allow you to, calculate this. But my point is, if you use one brokerage, Zerodha is an interesting example because they actually show it. There is a way for you to say, you put in so much cash, you took out so much cash, you are able to now see how much your cash has become. You can see your rate of return over a long period of time. And that rate of return may be 10%, 12%, 14%. Many times people hate it because the last 1 year has been bad, but the 3 or 4 year cyclical return is actually quite good. When I say that, I mean, it's like, okay, it could be like 13%. Now 13% sounds lousy to you because you have seen the 40%, but for me 13% is fantastic. So the economy is growing at 11-12%. I think you're getting 1% more is fantastic from that perspective. And if you're getting the 13% in this down cycle, you're actually doing quite well for yourself. And especially because you've been around for nearly 4 years, I think one thing you should do is calculate that. That will tell you whether your portfolio is in the red, or you're going through a cycle where your returns have come down from the 17-18% down to the 13%, and then maybe it's 13% still acceptable. Many times people choose wrong stocks, so they don't know. And to that extent, the first 2-3 years of your life, you should pretty much write off, saying, you will try futures, options, this, that, all the drama, and then you lose a lot of money. That's fine, because that's like education. You're just paying for your own education, and then you're this thing. That's also, but you should know how much, because otherwise you don't know. Just looking at your portfolio in the red is one thing. The other thing to understand is mostly people don't know why they bought certain stocks, because it starts off with, I read one report, I saw something that sounds interesting and all that stuff. Do you really believe in those stories or stocks right now? And if you don't be in them, because then you don't know why
regardless
you bought
of the bull run, bear run, whatever it is.
If it's a bull run, it's doing well, you bought it because of enthu, and that's fine. It's entertainment. But now it's not entertainment because it's making you miserable. So you're not even feeling good about it. So why hold it? And second one is, you don't know when to sell it. But if you don't know why you bought it, then honestly just sell it. This is not your cup of tea, and it's okay, because you don't have to be a master of everything. You can be a master of what you do in life in general. That's the thing I talk about as failure, because when you don't have failures in the early parts of your life, you treat each bad stock as a failure. and then that makes you feel even more miserable. Then you're like, I'll wait for it to come back, and then only so that I don't record it as a failure in my life. It's okay, record it. It's okay. Everybody fails all the time. Now we should compulsorily fail some kids randomly in early parts of their life so they know what it feels like. Because it's not your fault. It's not even like sometimes you must have brought a great stock. You just didn't know that something would come and destroy their life.
Right.
And even the company didn't know. Sometimes great companies also face a lot of challenges. Their stock price goes down a lot. And it's okay to say, I didn't understand what's happening. I'll walk away. Let this company come back, then I'll buy it again. It's fine to say that. And the thing is that we have to deal with this situation, which is this is not a failure of our part. It's just bad circumstances, and let's move on. It's
Is there any particular kind of things, let's say I have very little clue about the markets, but I'm still keen on investing or something. Should I keep it as keep my entire cash, everything in cash only, or should I put in mutual funds because everything is down?
To that extent, if you're thinking, you're young, so you're in your early 20s, so you're thinking 10 years from now. If the market does what it usually does, you'll end up with 3x your money. No matter when you invest, typically the returns have been of the order of in a 10-year period. I don't think we've seen anything less than maybe 7-8% a year, or as much as 15% a year. So average over 10 years. So even in the Nifty or something like that. So best thing is to buy yourself a bunch of mutual funds and keep investing in them regularly with certain amount of your money. Let's say you take that with 50% of your money. At all points in time, you just stay invested with 50%. The remaining 50% you enjoy, you find a way to kind of do your trading or whatever it is, learn more about the markets and all that. Relatively small as a portion of your net worth.
Entertainment money.
Yeah, it's I mean, initially at 22 and all, it'll be 50% of your money. Eventually, when people cross 30s, I say 5% or 10% of your 5% of your money. So 5% of your net worth keep for entertainment, keep for learning, because then by that time you would have saved roughly maybe 50, 60 lakhs. So 5% is 2.5 lakhs. You can still play with that. So that's the idea. But in the long term, staying invested is usually the better way to kind of make long-term money, mostly because you neither have the time or nor the inclination to figure out what is the right time. Because when people are the most scared, is the right time to invest. I'm still not seeing that. To be honest, I haven't seen people like so scared. I'm talking about when people are that scared, you'll be talking to me about the state of Bangalore roads. You will not be talking to me about the markets because we're done. So it's like nobody wants to talk about the markets anymore. And there's some seething anger inside and all that. We haven't seen that situation for a long time. In fact, even in COVID, one of the things that happened, even the market was down 40%, we were actually seeing bullishness on the streets. So maybe something in India has changed in terms of that feeling that
fear of
extreme fear and depression is not coming. People seem to be more stable. The economy is actually quite doing well. So I honestly, I don't think any problem with the economy. The government finances are fantastic. Our imports and exports, the deficit is actually much under control. We have a tremendous amount of business activity going on, economic activity going on. So I don't think this is a bad economy. These are bad markets, but that's fine.
So does the stock market or the bear market right now, or whatever you want to call it, does it say anything about the economy, India's economy?
No, that's the point. It doesn't always necessarily say anything. Usually prices lead a problem. That means you say there's a problem coming in ahead of you. You don't know what that problem is, but prices get vary even before the problem actually happens.
Okay, so it's already priced in key.
Not priced in, but it's basically expecting that problem to happen. So the uncertainty causes issues. So it's possible that the current market downturn is expecting some issue that is going to happen down. And maybe because of Trump. Trump can come and change the game, and maybe he does change the game. And if he does change the game, markets go down. If, like I said, foreign investors sold 3%, they could sell 10%. And maybe we can't absorb all that much. And that's what's going to change everything. But by and large, my feeling over here is that we should not be too unhappy about what's happening. At some level, this is a reset. There will be a change in the underlying economy that caused it. India is a massive, massive economy. But as much as we've said, our economy has not created enough products or tools that serve ourselves. If you look at Amazon and Flipkart, nobody else is out there in the e-commerce space in a meaningful way. There are lots of Indian players trying, but nobody has reached the same size. Perhaps that will also have to come. We'll have to get more, because those companies are losing money hand over fist just to be able to break into our Indian markets, and our giants are not able to compete, saying we don't want to lose that much money. So using a loss leading mechanism to break into the Indian market will be okay, but at some point India will have to develop its own things. What will happen with this Trump is probably it will force that, saying we don't want dependency on Amazon, let's build our own thing. We don't want dependency on phone pay or whatever it is. And these companies need to either get Indian in terms of ownership and control, or they get competed with in a way that the other companies kind of take market share from them. So I think that, so, and it's true, so to a very large extent, for the longest time, even the financial services industry was dominated by foreign players.
Right. I remember my cousin telling me Citi used to be a very big Citi
Citi
bank.
was huge. Citi was the only company which had ATMs everywhere in Bangalore and all that stuff. Every city. Now nobody hears of Citibank as a retail. It's not even a retail bank anymore. It's sold as retail bank to Axis. I'm not unhappy about that, but I think at some point there was Stanchart, there was Citi, there was all the big trading and dealing in the Indian markets was done by them.
Right.
Even from the 80s and 90s. It is now that HDFC and ICICI have very strong desks. Even the PSUs, fantastic trading desks. They form significant portions of volume in the trading desks. Even today, some of the sales that the dollars are happening, a lot of speculative plays are coming through foreign banks. And trying to beat down the dollar to the rupee. So what happens is the Indian branches of those foreign banks end up selling the rupee and buying the dollar, even though there is no innate demand for it, primarily to meet speculative needs. Right. Now the speculative needs could be internal because their own trading players are like, let's beat down the rupee. They have been very strong, but countering them today also, the Indian banks don't have the heft, or they have the heft, but they prefer not to use it to be able to. And RBI also needs to loosen up on this because a lot of ownership issues are there. But there is a move to make these things more Indian owned. So when you look at software abroad, they deal with things in very different ways versus software in India. So you have to kind of customize it in different ways to make software available for India, and the Indian brokerages have done that. So the similar things you can think of as textiles. India has specific needs for textiles. Most of that is manufactured here, and we managed to do that. Our cars require a certain,
according to the roads
and all that stuff, and different types of suspensions. So our cars are built towards manufacturing that. We can't make massive trucks because of certain tax laws that disadvantage anything that's more than 4 meters. India is very specific in a lot of ways, right? So these foreign investors they may participate, or foreign this equation around in the market may change based on if Trump becomes like this, I won't allow Indians to export to the US. So India will be like, fine. We should be like, every other country is saying this. Fine, we also won't allow you to export to India. They will cause a recession for sure. But I think we are in a much better place to handle that recession because internally we have growth. Our growth is not driven by the fact that we export or import. Our growth is primarily driven by domestic consumption, domestic economy to a very large extent. We need to improve that. Even today, logistics has improved dramatically in the country. We can make it increase even 5x more. But we still need businesses to come and harness that. Like I said, we have to break down the laws, remove the shit in the laws. And once we do that, we'll promote our industry. And I think, honestly, sometimes in India, it's always been the case that the more money you have, the more easy it is to build a business. Because if it's a function of money, then I have to just pay X people. I have the ability to pay X people and then we get it done. Right? For the small guy, it's almost like, dude, I don't have the ability to pay. Because they won't even let you start. Right. Which is why the rich get richer and the poor don't get richer. I want to see in India where the rich get richer, that's fine, but as long as the poor also get richer. So both need to get richer.
But coming back, I wanted to ask, when was your first bear market, like a proper bear market where maybe stocks were down, the index was down 30-40%, and
2000, yeah. 2000 is when I first started investing. So
that's 25 years back.
25 years back. So that was horrible. That was just like minus 80% on the market, and it lasted 3 years.
Correct.
So 2000 to 2003 nearly. Though 2003 was a very good year. 2003 up till the middle was really horrible. And then
And you were all in, or
no, I had no money at that time. So whatever little money I had invested, I lost 80% of it. I bought a mutual fund. In 2000, there was no online, so you had to fill form and stand in line and all that.
I can't relate.
Forget. You guys can't even relate to cassette tapes. And then there's been CDs, DVDs after that, which also you can't relate to. And then now you have, I don't know, streaming everything. So what I'm saying is that you won't relate to this. This was even, I don't relate to it. I don't know why I did it. why did I stand somewhere in line and do this? But I lost 80% in that investment. I waited for at least, I think, 40, because I had forgotten about that investment. It took at least 7 years for it to come back to the face value.
Oh.
At which point I had found those shares. That it was a certificate.
Physical. Yeah.
So then I went and sold. I gave it to them and I said, give me the money back. They gave it to me after 7 years or something, and it's fine. It's not like it was.
But at that point of time, I'm guessing it would have been hard on you when you saw,
it was more hard on my business partner at the time, because he invested a significantly higher amount of money. I had 10,000 bucks. That's all I had. I didn't have more money. So.
But 10,000 bucks at that time is
it's a lot. It was my salary, 1 month salary. So to that extent, you lost your 1 month salary. It was all my savings. And I didn't have any more savings. So I was like, okay, miserable for a while, but it's okay. Because we saw this. In fact, there is a lot of, the stock market has downstream impact, right? So when people see the stock market fall, people don't invest, they don't spend, they don't want to give you contracts and all that. So we saw a business impact of that, both from Indian customers and from US customers, because they were also in that stage of dealing with things.
Right.
But the good thing was that people who were doing well, by the way, Google's IPO came in that bear market.
And 2000, around 2000?
I think 2002 or something. The interesting thing was companies that actually did well during that time, did phenomenally well. And all our IT giants were doing really well at that time. I know because we were competing with them.
Oh, you had a IT company at that point of time.
At that time. And then we were seeing that the business was strong. We would lose people to them. They were hiring by the hundreds. And, even through this bear market. So it was not like, I think bear markets are bear markets for some, but bull markets for others. So if your competition dies and you don't, for you it's a bull market. So because the demand just comes to you. The demand may not be growing as overall. Like, there are 50 shops in a street and each of them is doing a business of 1 lakh a day. That's 50 lakhs a day. 48 of those shops shut down.
And
then let us say that 50 lakhs a day has come down to even 30 lakhs a day. For those two shops, it's 7.5 lakhs a day. So I went from 1 lakh a day to 7.5 lakhs a day by the virtue of, even though the market has shrunk, right? So for me, it's a bull market. For you, it's a bear market. So it's that happens quite often. And sometimes that's where you kind of find the gems of the next whatever move and all that stuff.
Is there any particular sector? I think this might change across every cycle. But is there any particular sector which performs really well when the markets go down?
Yeah, they call this. These things in the markets will call them defensives and all that. I have seen a lot of stocks which are called defensive, which are not. So they say IT is defensive. They say FMCG is defensive
because they grow at a moderate pace.
They say that people will always buy toothpaste, for instance. So therefore, you should buy toothpaste company. I'm like, yeah, that's fine. But if you overpay for a toothpaste company, the same toothpaste is going to yield the same tiny little profit, and I'm willing to pay less for that profit. So it's no longer a defensive. It's a business that's not going to die for sure. But does every business that doesn't die, is it a great investment? Would you not buy Coal India forever in that case? Because people will always need coal at some level or the other, and it's a monopoly in serving coal in India. I don't think that is a fair comparison to. But here's the thing, people will label anything defensive based on anything else. At some point, even the most ordinary company can become a defensive, and the most extraordinary company can be a horrible player to play with. Between 1974 or 1973 and 1982, 9 years, there were a set of companies in the US called the Nifty 50 at that time.
Yeah.
There were 50 companies that they said these stocks are fantastic. They can never go down. You should just buy them forever. They had come after a bull run of maybe 7 or 8 years, except the next 8 years they almost fell 90%. And of these, one of them was McDonald's. McDonald's had a 3% stock price CAGR over 10 years. McDonald's, which is like everybody goes to and has burgers, it doesn't die. You know that it doesn't die. Yeah. And yet, you get only 3% return over 10 years simply because it was overpriced at the time when it started, when you started the measurements, right? So it's possible that you look at a defensive and say, well, fine, my company didn't die, but you know what? I could have got more money in a fixed deposit. On the same front, you say other company which you think is going to die, so not good. So it's like Bajaj Finance. When it came, they said, what do these Bajaj people know about lending? They make scooters. When it came out, it was in a lot of stress, and they said, oh boss, these people don't know. And that guy turned this thing around, and within 10 years, it was a 15x, 50x, 100x, I don't know, some crazy number like that. You didn't think at the beginning that you would bet on this company. Yeah. And yet, in the end, when you come and look back, you say, I should have bought it at that time. So, the weirdest of companies emerge through bearish markets. So, you get stocks which can perform very well through bear market. This is the time to start looking at those kind of stocks where you say the story is changing. You might end up paying high rupee values for them.
Right.
But it typically means that these companies have growth on their side. And if you see visible growth, that's the important. And I'm excited because it's a stock picking market, right? So it's a great way to say we should pick stocks.
So since you manage money for a lot of people, do clients call you and tell you why is my portfolio down, or what should I do? Like, how do you deal with that? I'm sure that must have happened.
Let me ask you this from a counter question perspective. Okay. Do you ever feel like, I don't know if you use advisors or you do it yourself, you probably buy mutual funds. Yeah. Do you ever write to the mutual fund or feel like writing to the mutual fund saying, why are you down compared to everybody else? But let us say you do also. It's still a question. Heck, why is that falling 15% or something else falling 10%? It's normal. I think over a period of time, you get used to this, even as a fund manager, because there is a reason why some of these companies who are in this space, in the fund management space, they have dealt with these situations before and they'll be able to give you answers. My general feeling is this: if people are unhappy, so unhappy that they find it that your behavior questionable, saying you should have done better, this thing, you cannot convince them meaningfully. You put in your best efforts and you say, okay, this is what I did, and yeah, it didn't work out. There is a factor of luck involved, there's a factor of skill involved. Maybe the skills were also not so great, but that's a learning process. Eventually, forever you'll be learning. But a lot of luck is involved as well. And if you let the skill part of it play out, which takes time, then over a period of time, you have to see my performance. So you see my performance through bear markets, not through bull markets. So I will tell you that you see a performance through COVID from 2020 to now. So that you can see us at least having handled one bear market. I've seen many, but I've handled money only through one, as a PMS only through one bear market, meaningfully. And then over a period of time, have we learned, have we improved, have we stuck to the principles that we have had, and then the discipline allows you to kind of make money. I think that is where you have to convince people. But in the end, if you've done it for them once, they typically say, well, I trust you. So whether you you have a philosophy called momentum. We have one. We use that momentum strategy to buy stocks. And this time, momentum sucks. But I find that the biggest questions will come from people who come 1 year ago. The people who come 3 or 4 years ago have seen a cycle.
What do you tell those people? I mean,
it sucks. The market sucks. Yeah, we have seen this before, and it will go. It will be a cycle when it will be down. There will be a cycle, then it comes up, and you won't be able to explain why it's up.
Is there normally a time, like how much time does it normally take for the market to bounce back up again? Like,
there's no given time frame. So sometimes it can take a year, 2 years, 1 year, 6 months. But this time has been extraordinarily bad in terms of time frames in comparison with the past. But this time the selling has also not been intense. So maybe the intense selling will come one day and allow the bottom to be formed at some point and all that stuff, and then go on. Or maybe it's already done. So I can't predict when that situation is. But sequences are like this. Your markets will react to events, and those events have to be in some way positive or moving towards stability. Today we're still seeing instability. Trump is out there, drama is happening between Ukraine and Russia again. But when those wars stop, then we will see that stability, and then the markets will emerge out of that, right? So as long as there's the instability, you should expect the markets will remain weak.
Right.
And I don't know, it's like rain. Bad weather will come. It will go away. It's not like the whole world will collapse in case of it's possible. Right? There can be an earthquake and everybody could die. But you don't think that every day, right? You said, oh, it's raining. It will stop raining at some point. All right. Even in the coast where it rains a lot, it does stop raining at some point. So you just wait for it to happen. And that's natural because you're being conditioned over it for so many years. You live 22 years. You've seen 22 cycles of this. Your body has. So you're naturally like, it's raining, it'll stop raining at some point. That time we'll do our activity. If it's raining for 3 months, then we'll live through those 3 months. And then after that life, so you don't go and do, even though you might like trekking, you don't go trekking during the rainy season because the routes will be wet, the situation there could be an avalanche or all sorts of things.
Yeah.
So you don't want to do things in the wrong season. You know that naturally. So what will you do? You'll say, okay, I won't do those things. I'll do some other things. So maybe you don't buy the companies that you think that will grow in the next 3 months or 6 months, because nothing will happen in the next 3 months or 6 months. You want to buy more stable companies and kind of stick with that. And then when the opportunities start to arise again, you're going to get more aggressive in your portfolios and kind of change things.
Right.
If you don't understand any of this stuff, you just keep investing in mutual funds and then let them play their whole arm out.
Right.
Let them figure out which stocks to buy.
Right.
That's also a fair ask. If you ask me, it's just simple. I think you just have to live through the storm. That's the whole consequence of it.
Good. I think this is a good note to end this podcast conversation on. Thanks so much, Deepak, for doing this.
Krishna.
Thanks for taking out the time.